S&P 500 is currently trading at 22 times forward earnings. What are forward earnings? It is the earnings projections of the analysts on Wall Street over the next 12 months divided by the current price. Does the traditional advice model of predict the future and beat the market and focusing on everything we cannot possibly control, does that help you meet your cash flow expectations? Clearly it does not. The two are not related. Which brings me to another important aspect of the Moneyball Method. What is it that drives investment success or failure? Hello, welcome to the Moneyball Method. My name is Mark Shupe, and I am the author of the book, The Moneyball Method, a Middle-Class Manifesto for Objective Investing. This is the second in a series of podcasts that will discuss money and investing and how it relates to you and your life and living the one life you have with confidence. Before getting into that, I want to stress that I will not be making any recommendations regarding specific securities such as stocks, bonds, mutual funds, or exchange-traded funds. But I will be talking about investment strategy as it relates to you and your life and living the one life you have with confidence. For background, I am retired from a 32-year career in the financial services industry. I served as a financial advisor, training manager, branch manager, compliance officer, and trust officer, most recently with a regional bank's trust department, acting the role as portfolio manager. The topic for today's conversation will be to make money for what? And this is an important question that differentiates the Moneyball Method from traditional investing advice and best practices. What I've discovered that there is a great deal of consensus out there that the purpose of investing is to make money with as little risk as possible. It does not answer the question to make money for what. And that is one of the reasons I wrote this book. What I'd like to do is start with some of the common misconceptions about money and investing. And what I'm going to do is quote from a book that was published earlier this year by a registered financial advisor. And she had interviewed 47 people to ask them the question, what does money mean to you? Or what is financial independence? The first quote was common to almost all of the respondents that were interviewed, and it reads in part, money provides security for the future. Money provides a comfortable lifestyle. And I think most of you probably agree with that. But does that really answer the question, what is money and where does it come from? The second quote I'd like to share with you is, I think money provides freedom to travel, to drive the kind of car I want, live where I want, not be a burden on anyone as I age. Now that's getting a little closer to home. That discusses the purpose of money and partially answers the question to make money for what. But does it really understand the nature and cause of money and wealth? The third quote I'd like to share says, money is not static. It depends on where it flows. It can create pathways for impact. I like to realign into good things that provide good opportunities for helping people. Now we're talking more about the purpose for money and how it can be converted into the things that matter most to live the one life you have and give it meaning and purpose. To me, the fourth quote is probably the most meaningful. It says, money is not a means to an end. My view has shifted from focusing on making money to focusing on ways to add value. Money is a means to an end. Think about that. Money is a tool to help you accomplish what you want to accomplish, but it does not replace you as the driver. It also transfers the goal of making money for the sake of making money to having a purpose for the money that you do earn. Right now, I'd like to shift to the concept of making money And I believe it was President Calvin Coolidge who said over a century ago that the business of America is business. In other words, to make money. And making money is a noble venture. Don't get me wrong. To make money is a worthy goal, particularly for an entrepreneur, particularly for a manager at a corporation, particularly for someone who is running a business and trying to earn a profit. Earned profit is a noble venture. It is very difficult. It is very challenging. It is very complicated. And what a business owner does when they are trying to make money is to enhance shareholder value, provide a rate of return to their investors, provide value to their customers, and to provide a valuable experience and career path for their employees. They have many constituents that they're trying to serve when it comes to making money. But for an individual investor, it's a little bit different. To make money for what? Or to make money for the sake of making money might cause you to make decisions that are risky or do not help you meet the goals and aspirations that help make your life worth living. And the reason I think is that people do not understand the nature of money. Money by itself can do nothing. Money is only valuable in terms of what you can do with it, what you can exchange it for. What are the material goods, the services and experiences that you can acquire that are important to you and the people that are of value to you? In essence, money is production. We don't buy things with money. We buy things with the goods, services, and labor that we can acquire with the money that was produced by goods, services, and labor, which brings us to goals and objectives. As the subtitle of my book says, a middle-class manifesto for objective investing. The goals and objectives that we want to talk about are the material goods, the services, and the experiences that are important to you and your family. But I'd like to move into the second block of today's conversation, and that is what is going on in the world of capital markets today. What are the headlines? What are the questions and concerns that you might have as an investor? And for that, I would like to turn to the chief strategist at JP Morgan Asset Management. His name is David Kelly. David Kelly is one of the best that I am aware of within the financial advice industry. He is a strategist for JP Morgan. I've had the chance to meet him personally, and we can learn a lot about what's going on within the economy and the markets just by reading some of his work. And this is from 3 days ago, dated September 2nd. David Kelly wrote, through August 29th, the S&P 500 achieved a total return of 10.8%. The Bloomberg U.S. Aggregate Bond Index returned 5%. Now let's think about that. What do those numbers mean? Let's put them into context. A 10.8% return for the S&P 500 is roughly equal with the median historical return over the last 100 years. But that's for the first 9 months of the year. So that is well above the median return over a 12-month period. A 5% return on the aggregate bond index is also in line with the long-term historical averages. However, that is also a 9-month return, and translating that to 12 months annualized, it is well above the median. So 2025 has been a well above average year in terms of both stock and bond market performance. He goes on to say that the MSCI All World US Index generated a total return of 13.8% in local currency terms. Relative to the US dollar, that's over 22%. That is well above the historical averages. What does that mean? It means that international stocks of developed economies around the world, specifically Western Europe, Australia, Japan, generated returns that are well above the median. Now let's go back to the first sentence in this article, starting with the good news. It has been another great year so far for diversified portfolios. Well, if everything is moving up at the same time and everything is moving up at a higher pace than the average mean of return, there's not a lot of diversification going on there. But let's talk about valuation. The S&P 500 is currently trading at 22 times forward earnings. What are forward earnings? It is the earnings projections of the analysts on Wall Street over the next 12 months divided by the current price. 22 times forward earnings is an estimate because earnings projections are an estimate. But relative to forward earnings projections in the past, that is a very high valuation. One might conclude that stocks are overpriced. There's also 1.6 standard deviations above the 30-year average. What does that mean? It means that current values of stocks are 60% higher than valuations on average over the last 30 years. That is substantial overvaluation in that context. But let's put it into greater context. What does that mean across the board throughout the entire US market? Is everything overvalued based on these metrics? And the answer is probably not. Much of that valuation comes from the largest US companies, and the smaller companies and the so-called value stocks have not achieved anywhere near that kind of market growth. So diversification actually is working if you own a broadly diversified portfolio across all market sectors, at least within US stocks. David Kelly goes on to say that the riskiness of an investment strategy depends on the relative weights of the assets in the portfolio. That is true in his context. In the context of a Moneyball investor, it is not true. David Kelly does not know you. David Kelly does not know what your life expectancy is, what the value of your financial assets are, what your goals and aspirations are, what your saving and spending habits are. He has no idea what your cash flow expectations could be. That is where the Moneyball method comes in. The other thing to understand is that everything that he wrote in this report is already priced into the market value of every security that he's covering in his research. The market knows this. The market possesses greater knowledge than any strategist or any committee can possibly comprehend. That is where the Moneyball method comes in. So based on this information, what do you do as an investor? Perhaps nothing, because we cannot control what the market is going to do. We cannot predict the future of market capital performance. What we can do is control what we can control. That is one of the top precepts of the Moneyball method. The second one is to avoid unnecessary sacrifice and risk. What is your risk exposure to these overvalued assets? If in fact they are overvalued, only time will tell. We don't know. We can't control that. It's about controlling what you can control. And what we can control with regard to the uncertainty of capital market performance is our exposure to market risk. From here, I'd like to switch gears and do a little bit of a question and answer with you. This is where I'd like you to introspect and perhaps learn a little bit more about your attitudes toward money, investing, and answer the question, to make money for what? This is a very brief question with 3 short multiple choice answers. Just listen and respond as best you can in your own mind. The important factor for success of an investor is A, to select managers or stocks that outperform the market. B, a customized portfolio across asset classes and styles. Or C, to meet or exceed future spending goals. I'll read that one more time. What is the most important aspect of investing success to you? Selecting managers and stocks that outperform the market, a customized portfolio across styles and asset classes, or meeting and exceeding future spending goals. If you answered A, you would agree with the majority of investors and advisors. Outperformance is a big deal. Beating the market is the common goal of most investors, and that is how investment managers' performance is measured. It's called adding alpha. Adding alpha means how much did I beat the index that I'm being measured against, whether it be the S&P 500, the Russell 3000, the MSCI World Index for international equities, or the Barclays Aggregate Bond Market Index for fixed income. If you selected a customized portfolio across styles and asset classes, you would agree with most of the industry. It's about risk-adjusted returns. It's about customizing a portfolio with broad diversification, filling all of the style boxes: value, growth, large, small, domestic, international, high yield, high quality, alternatives, in order to maximize the benefits of diversification. Unfortunately, over diversification may not work very well. Answer C, meeting or exceeding future spending goals. This is the Moneyball method. It answers the question, to make money for what? Bear that in mind, please, as we go to the second question in today's survey. The question is, your higher priority investment objective is A, to maximize returns while avoiding down markets, above market risk-adjusted returns and never going broke, or to meet spending goals without pointless sacrifice or risk? Sounds very much like the first question. To maximize returns means beating the market, to select outperforming managers while avoiding down markets. How is it possible to outperform while avoiding down markets? Well, there are many investment portfolio managers who that is their goal. They claim to be able to do it successfully. But I would argue that that would only sacrifice returns, meaning sacrificing lifestyle in the long run, or taking risks that we cannot anticipate. To meet future spending goals answers the question, to make money for what? So to dig a little bit deeper on investment and value-driven investing, let's talk about the things that are important to you and your family. In order to steer the conversation toward the things that matter the most, that make your life worth living, what I've done is created a chart, a tool that helps you make decisions about the things that you want to dedicate money and time to. I call these the value domains, and they will help you think about what it is that matters most. And I divide those into 4 different broad categories: family and relationships, business and career, health and fitness, and wealth building. Those 4 broad categories can then be divided into many subcategories depending upon what's important to you. Those subcategories I call your value inventory. Again, it answers the question, to make money for what? And the important thing to remember is that all of these are interconnected. Your value inventory can include things like your house and home, professional and charitable objectives, the arts and entertainment, recreation and sports, travel and vacation. And again, the goal is to help you understand the things that are important, the things that you want to dedicate time and money to, and be able to put it on paper and to define them objectively. And that is key. We want to be able to define specifically what it is we're trying to accomplish. And that's important, but that's only the first step. What does that have to do with money and investing? Well, it has quite a bit to do with it, because any of those that require money should have a dollar amount attached to it, and should have a time at which that money is needed. To make money for what means, when do I need it? How much will it cost? And how does it add value to me in living the one life that I have? And sometimes that can be a difficult question. And I introduced another tool in my book, The Moneyball Method. I call that the fact and value matrix. Once we have identified the value domains and the value inventory and how all of those work together, we have identified everything we know about and can control. Your age and life expectancy, your financial resources, your savings and investing habits, the goals and aspirations that we're trying to achieve. Remember, money is not of any value except for what we can convert it into. And for that, I devised the fact and value matrix. We'll put them all into a grid. And in the upper left-hand corner is what I mentioned earlier, that one aspect that we can control with regard to capital markets and investing, and that is your risk exposure. For example, would I be willing to take more investment risk to retire sooner? Would I be willing to take more investment risk to have more money to spend during retirement? Would I be willing to take more investment risk to fund my children's college education? Would I be willing to take more risk to have money for travel and entertainment? By the same token, would I be willing to retire later in order to have more money to spend during retirement? Would I be willing to retire later to be able to afford college for my children? Would I be willing to retire later to have money now for travel and entertainment? It goes on and on. Every one of the goals and aspirations that you identify that need money and have time assigned to them can then be evaluated against each other. And that's important. And that's where having a skilled financial advisor might come in handy. How do we translate all of those responses on the fact and value matrix to the investment strategy, meaning your risk exposure, ultimately answering the question, to make money for what? And in conclusion, I want to talk about this in terms of how a successful business operates. I want you to adopt the entrepreneurial mindset. What are the attributes of a successful business? They meet the needs of their customers, they're easy to use and understand, and they are reliable. And my topic today, to make money for what, is about the first one, to meet the need of the customer. You are your own customer. What are the needs that we're trying to meet? Does the traditional advice model of predict the future and beat the market and focusing on everything we cannot possibly control, does that help you meet your cash flow expectations? Clearly it does not. The two are not related. Which brings me to another important aspect of the Moneyball method. What is it that drives investment success or failure? Is it your asset allocation strategy, as implied in question B of the two questions that we had earlier? Is it predicting the future and beating the market? Hiring outperforming managers, adding alpha? That is what nearly everyone believes, but it's not true. If cash flow matters to your ability to meet the material needs, the experiences that make life worth living, then the Moneyball method may be for you. What we've discovered is that the top two factors for investment success or failure is the timing of your cash flow and the order or sequence of investment returns. What does that mean? It means that if market values drop sharply soon after you retire, you may run out of money. Meaning, during the withdrawal phase of your life, a sharp decline in markets that we cannot predict or control would have an adverse impact and your ability to meet your cash flow expectations. Conversely, if you're young and you're starting out and you're investing on a regular basis, a drop in market prices could actually benefit you. The timing of the cash flow matters. That is what we pay attention to. The order of sequence of returns is a form of risk that is largely ignored by traditional best practices, but one that we anticipate and that we model, that we simulate, and we determine your funding status, meaning, will I meet or exceed my spending goals over the remainder of my life? And that in turn becomes the new performance benchmark. Instead of measuring success looking in the rearview mirror, comparing our results against some arbitrary benchmark like the S&P 500 or the MSCI All World Index, or like the Barclays Ag Bond Index, we measure performance looking forward, looking into the future. That performance benchmark is you and your life as the investor. Hopefully that answers the question, to make money for what? And thank you for listening today.